Good morning, good afternoon, everyone. Thank you for joining us today on our back to school edition of ARIVE Partner Spotlight. ARIVE Partner Spotlight is a monthly webinar series that we host where we invite experts from our lending partners to talk about topics that are relevant in today's market and which can help you guys grow and scale your business. My name is Harish Tejwani. With my colleague Amy Hullett, we'll be moderating the webinar session today. Today, I'm really excited to say we have a masterclass set up for all of you. Joining us today is one of our earliest partners, AFR Wholesale. So my good friend, Rob Pieklo, is joining us from AFR. He's the COO of AFR. AFR has gone through a big transformation this year. So we will see what he has to say about changes in AFR, how they're growing. And we also have mortgage pricing master, Matt Graham, joining us from MBS Live. So we thank you, Matt, for your time. Be sure you have your notebooks open and you're ready to take notes as you learn about ins and outs of how mortgages are priced, what is happening in the future, are the rates going to go up, are they going to go down, what impacts mortgage pricing, so on and so forth. So with that, Amy, do you want to say anything, or should we get started with Rob? If anyone has any questions, feel free to use the Q&A tab below. We'll take them as they come. We have an absolutely awesome topics to cover, and maybe Rob, do you want to get started, or Amy, do you want to say anything?
No, I'm just excited. We've got a lot of people here. Like Harish said, just please ask your questions. They want to take them live and tackle as much as we can. So thank you both so much for being here.
Well, thank you. I guess I'll start off by saying thank you. Thank you for having us. Thanks for being an incredible partner. And it's been fun to kind of take the ride of your growth and kind of piggyback off of it. And we know that, you know, when it comes to LOSs and having lived in it and worked in ARIVE and kind of seeing the competition and what's out there for originators, there's no better partner out there, because it's not about even where you are, which is amazing, but where you guys are going. So I want to say a big thank you to Harish and Amy, and your teams have done an amazing job. And if you're an originator out there on the fence, this is the place. This is where you got to go. This is where you should be originating your loans in. So there's the plug there. And I wanted to go ahead and just talk about AFR. So we'll start and say, first, thank Matt Graham for coming here and joining me in this. And there's a lot to talk about. There's always components of pricing. I'm going to run through this stuff quickly. This is the shameless plug that we have in here. AFR is new. We're the new AFR. It's a little bit different. I have a full circle moment coming back and being able to work with a fund to purchase AFR. We closed in February. There's new ownership, new leadership. Some of the highlights I'll go over real quick. February to July comparisons, wholesale and non-delegated volume is up 350% since February. Conventional loan volume is up 1,100%. It was a small number to start, but still impressive growth. Our conventional volume last month and even just a part of July surpassed all the conventional volume that was originated of 2023 for AFR. So some big numbers that we're putting in. Our total volume doubled, but we really have been focusing on that non-delegated and wholesale channel and that broker business. We love it. That's part of our investment thesis. So it's been fantastic. We're different. It's different. We're taking the feedback. We're making changes, and our average conditions per file down 35%. You see on the slide, it's just a change of mindset. We even had to add a couple conditions for early CDs and other things that we've been doing. So that number is going to get even lower. And then we've been able to shave 7 days off our average turn time. So from setup to clear to close is a metric that we track. We've done an incredible restructuring of the organization, brought in like really, really good leaders. And then our customer satisfaction and it has just skyrocketed over the last few months. We've been seeing more and more positive feedback from the changes that we've made, and we're just getting started. So we're excited to start with our technology builds. Next slide, please. Oh, there we go. All right. Just again, we have a world-class capital markets team. That's what we started with. We have some of the best professionals out there that know how to get the best execution in the market. We do things a little bit different now at AFR, and most mortgage companies get the loans in, turn around and sell them and try and find the best execution on the pricing side for the company. We do it a little differently. We go to the secondary market and capital markets world and try and find the best execution that's out there certain pockets that may price a little bit better than others and turn around and pass that through our rate sheet. If you look at our rate sheet, your head might spin a little bit. It's not traditional. We have all different buckets, all note rate adjustments and all different things. The whole purpose of that is there's a lot happening in the capital markets world. There's a lot happening in terms of prepay speeds and specified pools, all this crazy stuff that changes the pricing. We want to find a way to get that to the originators out there. And that's why we've created such a complex rate sheet, but the pricing passes through. And when there's execution in the markets out there, we're passing that right through to the front end on our rate sheet so you guys can price aggressively, and we're content with the margins that we make on the loan. So we've reduced conditions, streamlined our processes, our customer service enhancements are through the roof. We have a proprietary portal that differs from a lot of different mortgage companies and wholesale lenders out there. We have our own. We're not using the out-of-the-box stuff from those big LOS companies, not to be named. We don't do that. We have our own proprietary portal. So when there's changes and feedback and things that we need to do, we build it. We make the changes, and we move quickly. So we are, right now, we have full control of that experience for your team members. We have a renovation portal, an OTC construction portal. There's a lot of different portals, not just from a broker perspective, but also after closing withdrawals and other things that happen with some of our niche products. And then Portal 2.0 project, we have an escalation team. An escalation means within the portal being rolled out a slew of different changes that we're doing in terms of initial disclosures, CD processes. All these things are happening within our portal. There's some really good features from our competition out there, and we love kind of looking at that and making it even better in what we're doing in our portal. So for us, we have to think of AFR. We are just an extension of your originations. That's it. You need us to get the loan done or underwritten and closed and funded. We need you for the origination. So the idea here is that we're just an extension. We're one team. We're getting feedback, and it's not, this is how we do it. And if you like it, if you don't like it, just go somewhere else. That's not how we work. We take the feedback in, we make significant changes to our processes quickly. And some of our largest customers are seeing the benefits of that by making these process changes that make sense. And whatever makes the job easier, because we know how hard it is to get a loan out there, whatever makes the job easier, we're going to look to implement. Next slide, please. Market insights. We got a couple things here. So we're doing this market pulse, and we're going to be doing it hopefully daily. We haven't gotten there quite yet, but we're trying to get as much information out to our broker partners as possible. There's usually one tidbit that goes out that goes over certain things about pricing or something maybe you're not sure how it works. We like to talk about it, whether it's MSRs or prepays or EPOs, whatever it might be. And then MBS Live, we have Matt Graham on today. The platform's awesome. I use it for my market pulse. I have access to all the really expensive, tools that are out there. I don't use them. I go on MBS Live. I love the chat, love the commentary, love what Matt does and that team. And we have an awesome promo code of AFR. And you get your first 2 months free. Matt, thank you for that. And it's an awesome platform. So if you want to use it, please register there and use that promo code so you can get your first couple months free. Next slide. Real quick, now there's I can see a double Howie there, so I can't move that. So there's Howie lens blocking the way. This is components of pricing of this. I want to give a quick tidbit before we get into all the technicals and all the stuff. There's a lot of confusion out there. We see different people pricing certain things. Coupon is not note rate, and it's really important to go over that. When you see pricing move, you see people like, well, the 5.5 pays 0.55. How come my 5.5 note rate isn't paying 0.55? There's components on the conventional side that you see here. So you'd have your 5.5 UMBS coupon. Your G fee is right around 50 basis. It's probably a little bit higher. It's like 56 basis points, but for the math, it makes it easier. That is a hit to rate. That is not a hit to pricing. That's a hit to rate. And then you have your servicing fee that's on there, which is required to have at least a quarter of servicing on your conventional loans. Now, if you equate it to pricing, you would have the 5.5 coupon would pay 0.55. You would have your G fee that is just a charge. There is no pricing adjustment there. And your service fee of 0.25 would gain some kind of multiple. We'll talk about that in a second. And that is a 1.25 adjustment to pricing in a positive way of value. And then you'd see your 6.25 note rate would equate to that 5.5 UMBS in most scenarios of paying about 101.8. So when you look at your pricing, just know that there's a little bit of a move, about 75 basis points higher from coupon to note rate when you're looking at conventional. Ginnie Mae is a little bit different. You can always use the coupon rate, as you see here. The 5.5 pays 100.52. And then you would see your service fee. There is no G fee. The G fee is embedded in the servicing fee. And then I just, for simplicity purposes, used a 3 multiple for the servicing rights that are there. And that gives you 1.5 point value for the servicing. The MSR is what it's called. And then that 6.0 note rate would be equal to what that 5.5 Ginnie Mae coupon is priced. So when you're doing your pricing and looking at stuff, that's how you want to look at it. Next slide, please. Oh, so I didn't know if you wanted to touch base on some of the ARIVE features and pricing, Harish. I know there's a lot of stuff you guys are working on in your background, and love to talk about that if you want to take a moment there.
Yeah, I didn't expect that, but thank you. First of all, thank you, Rob, for coming. We greatly appreciate the support from AFR. For most of the loan officers or brokers on the call, AFR was primarily known for niche products, OTC loans, one-time construction, and they have significantly changed. So as Rob mentioned, they are coming into a traditional conventional space. Even in ARIVE, they used to do maybe 5, 10 loans a month. Their volume has gotten 10 times, 15 times, and we expect this partnership to grow, working together very closely. We are kind of betting on the future. So they are they're in the game for conventional programs, government programs. So I would also encourage, if you are not signed up with them, give them a try. They will appear in marketplace pricing. That's a new feature we launched. So if you're approved with a lender, you'll see them on the left, and all the other lenders you are not approved with come on the right. So definitely, if you see AFR, there'll be a link to sign up. Give them a shot. In terms of pricing enhancements, oh my God. So I think one of the things we are pretty excited about, which is kind of obvious, is building a refi finder. So, I know you and Matt will talk about what's going to happen with rates. So I'll leave that to both of you. But it's kind of obvious, like markets have fluctuated quite a bit with the job reports and everything, and rates have come down. Most of the lenders have already priced in the changes which are expected in September. So one of the tools we are going to release, and a first version should go out this week, is called a refi finder. That means I can go back to all the loans I closed with any investor, and the system should tell me which opportunities are fit for refinance. So that's an exciting tool we are developing. And then we're going to move those scenarios into leads, and you can price them, and the system will tell them, and you'll be able to configure, I want to pick all the deals where there'll be at least 100 basis point improvement, or 500, or whatever you want. The MI is going to go away. So giving you tools by which you can identify refi opportunities, where the system is going to tell you which deals are more likely to refinance. That's something we are pretty excited about. And I think that protects the loan officer, with all the EPOs and everything going on. So our goal is, can we at least alert you about potential deals that you closed, so you already have a relationship, which are now kind of eligible for refinance. So that's one thing. As I said, a first version should go out this week. And then we're going to tag in pricing to that, you'll be able to run a report, and then the system will price those scenarios, and magically a list will appear, and you can put them in your leads pipeline, so you can then track them, what's going on.
Yeah, Harish, it's a good point too. I want to add just what a great tool, because that is the talk in the capital markets world, in the secondary markets world, and MSRs, like how the broker has never really been very good at recapture, and how these servicing rights go somewhere, and Mr. Cooper or some of the other these larger entities that are buying them up are going to have the ability to retain them. And here you're putting that opportunity back in the hands of the broker, and they have to act on it, because they're going to be attacked. Your borrowers are going to be attacked as they go, and we're trying to retain servicing here, and we're shipping those things back to our broker community. But those that are selling to those larger MSR aggregators there, that's part of the game plan. That's part of the game plan for them, is to refinance them. So providing those tools and getting in front of your customer early, not when it's already they're in the money, but getting to them early, and then having this tool, it sounds like a great benefit and add on to ARIVE.
Yeah, absolutely. And as you know, Rob, like we work with many lenders, so we'll let the brokers pick which investor rates. You may have closed the loan with X, but now a different investor or lender is giving you a better pricing enhancement. So I think that's the benefit. Since we are a marketplace where all lenders kind of are equal, so that's something we're pretty excited about. The other thing which I think we just released is something called inverted pricing. I'm not sure, Matt or Rob, you'll cover that. Like, often the pricing is inverted. The rate stack looks weird. So traditionally, ARIVE used to do like best execution at par. That's how that rate was picked up and shown to the broker. But now we develop algorithms that will kind of try to figure out not what is best execution at par, but what's the best deal for the consumer. So we will walk up the rate stack. If lower rate is giving better credit, so we figure that out. So that enhancement was very recently released, and I think that also helps our brokers to find what's the best kind of deal at that point in time for consumers rather than just going with best execution. So since that's the real rate on the rate sheet, we are able to pick it up. What else? So the other thing which affordability is big, a lot of incentives from agencies on affordable products. So another feature that should go out this year is the system is automatically going to find you if this deal qualifies for additional affordable pricing. So let's say you're pricing conventional and certain programs are coming up. We're going to automatically figure out by using census tract data, are there additional affordable programs based on income criteria and all that this specific situation might qualify for. So a lot of time loan officer miss that they're pricing out loans, sending quotes, but there are additional incentives available. So that's another interesting add to pricing. Let me think what else. Obviously, Rob, we have talked about doing a direct lock. So that's an
what's going to
interesting
happen?
project.
I'm gonna make you do it. We're gonna force it. I'm gonna have that going. That's the idea. We want to make it quick. We want to make it easy for brokers. So these are the things that that's why I love working with you guys so much, because I can have the discussion. I'll send you a text and be like, Harish, what the hell? Let's get this going. Like, we got to get this moving, and it helps the broker. That's not happening with some of the other LOS. I'll say that right now. That conversation is not happening. How do we get the ability, especially with the volatility that we see in the markets? We'll talk with Matt about that. And with the volatility here, we got to act. We got to act quick. And sometimes, there's a little bit of a delay, and that's where sometimes the broker side will struggle in the speed to lock with all the lenders. Some of the lenders are great at it. Some of the lenders are there. Here, if it's in your ecosystem, how do we move quick when the data is there and there isn't this huge requirement to kind of get things registered and moving? Here, you can secure some money at the price and do it quickly. So that's the thought process around that.
Yeah, and we also appreciate your open mindset. We have tried to implement lock over a period of time. It's a big deal. You're executing a lock on the loan. Lock is money. It's kind of everything. You don't blow up locks. That's what you say in the mortgage kind of world. So if you're able to do that with AFR, I think it's a huge win, not just for us, but for you guys as well. Like, loan officers who have priced out the deal, the pricing works. By clicking another button, it is actually going to execute a lock in the lender system. That would be a big win. So we are pretty excited. And thank you for, coming forward with this idea, Rob. So we also appreciate that.
Yeah, no, it's good stuff. And it all comes from LOs out there and brokers out there, right? This is the feedback. Like, oh, I would have sent you that, but it was a pain. I had to go do this, and this to get it locked. And I just did it over here instead. And you're like, oh, even though it was a better price. So that's one of those things. You listen, we understand, and we want to make it a little bit easier for them.
Yeah, the last thing I want to mention, again, it's not tied to pricing, but it is still tied to lenders' guidelines. And we get all this data from our investors, which programs qualify under what conditions. And so we are trying to build something called a natural language extension. So instead of putting a scenario and clicking run eligibility, brokers will be able to ask simple questions, which programs do not have any LLPAs for second and closed-end liens. And then we are going to run analysis over all the guidelines and come back, go to this lender or go to that lender, and you'll be able to engage with our system more like you're chatting with a bot. That's another thing we are pretty excited about. We are calling it Ask Arrive. It's not a pricing enhancement, but it is still tied to product eligibility. So by end of the year, we are hoping a version of this will roll out where we are able to ingest all the guidelines and overlays and anything else that comes from all the lenders and investors, and then allow our users to ask questions on top of that. So,
well, I took that slide out, but so I didn't think so. No one thinks we're stealing it from you. So we have the same. We have something similar with AFR with our guidelines and our niche products. So we have Ask Howie coming out
cool.
as well, and that same feature. We're all kind of jumping on that GPT bandwagon here.
Yeah, no, and I don't want to steal your thunder, but you will only do on AFR. I think our advantage is we can go across dozens and dozens of investors and kind of guide the user to the right kind of investor and product. So that's kind of what we think Arrive is on the front end of the stack, and as we add 20, 30, 35 investors, it would be a big value add for our clients, which are brokers. So.
Awesome. Well, listen, I think people are here. They want to know what's going on in the markets. They want to know what's happening with pricing. You and I, I know enough to get myself in trouble. I know that. and I go to Matt and just as the intro to Matt, and he doesn't like talking about it. He's repping this t-shirt, but MBS Live is an awesome platform, but more so Matt's commentary in the markets is, I feel like we've been aligned for years. I've listened to his commentary. I read his commentary. I've gone over kind of, everything he writes a ton for Mortgage News Daily. He does this stuff on MBS Live itself. in the chat within MBS Live. There's just a lot of really, really good information, not just technicals and charts, because he has a really cool background. I'm so jealous of that background. I need to like mirror that. I may screenshot it and use it as a virtual background. But I wanted to introduce Matt here, and I've known you for years, Matt. Thank you for joining us. And I'd love to get into one. We could just get into like what the heck is going on. We had this head fake, in the markets, and we've been talking to the Fed. We've talked about things being priced in. We have gone from like having like 7 cuts to having no cuts to having 2 cuts to having 4. Like it has been going all over the place. So I'd love to like start there, I guess, with the Fed. What's happening with data points? What happened today, and then what we can look forward to tomorrow.
Yeah, thanks. And I just wanted to address a couple things that you guys mentioned really quick that I thought were cool before we get on to that. Number one, the AI integration stuff. Not to one up you guys, but I actually have been powered by AI myself for about 17 years now. I was like one of the first actually AI in an Android body. So take that and try to beat that one.
Nice.
I also wanted to mention specific to ARIVE. When I want to know something about what's going on in the origination community, since I have been out of that game for almost 20 years now, I will just search MBS Live Chat, which has 15 years of chat logs in it. And if I search the term ARIVE in there, I really see nothing but positive feedback in there. So kudos to you guys on that. And then with respect to the complex rate sheets and the inverted pricing thing you mentioned, that's like music to my ears, because I've been trying to explain these things to people for so long and trying to tell them which coupon they should be watching and trying to explain to them why you will frequently see better pricing on, say, 6.625 than you will on 6.75. And that has to do entirely with what rates go into what MBS buckets. So different MBS coupons can accommodate different rates, and there will be pricing advantages, especially in a falling rate environment. So I just wanted to give my reaction to a few notes that I made while you guys were talking, because all that stuff sounded really cool and just the sort of transparency that originators have needed for a long time. So Rob, I think you asked like what's going on, what happened today, what's been happening in general. And, in general, since hyperinflation really took off after the pandemic, we've just been waiting for inflation to come back down and potentially for signs of labor market weakness to complement that. Sounds like a bad thing, right? Because nobody likes to lose jobs. But from an interest rate standpoint, if the Fed is seeing some labor market weakness and they're seeing inflation come back down to levels that are consistent with its target, it's going to consider cutting rates. The market's going to know that ahead of time, and the market's going to adjust toward lower rates even before the Fed has a chance to cut. Just this morning, we had the producer price index come in lower than expected, 0.0 at the core level versus 0.2 forecast. And that's good stuff. We really want to see CPI, PPI. Those are the two price indices that come out earlier in the month. We want to see those things hit month over month levels of 0.17. That's what's going to average out to that 2% annual inflation target. The headline numbers aren't reported in hundredths of a point, but if you pull up the report itself, or if you check MBS Live or other sources online, they'll say what the unrounded number is. And long story short, past 2, now 3 months, we're looking pretty good. And hopefully CPI tomorrow says the same thing, and it will take things to the next level.
Yeah, the momentum is moving in that direction, and we'll see what happens tomorrow. But you always like to see a little bit of green on the screen before a big day like CPI. I know a lot of people are waiting on tomorrow's report. I've seen a lot of people, you shouldn't be gambling with your borrower's locks. See a lot of people hanging on, saying, "Hey, I think I'm going to hang on for this report because we're going in the right direction." I got a lot of text around that as well.
So I have a question, Matt, on this. What makes such big misses? This whole employment report came up, they were expecting X, but the number was so low, and then everybody panicked. So do you have any insight? Like how come, we have so many economists and statistical analysts and Fed and all the powerhouses and brain power? What leads to these wide swings where forecasts are so way off that markets and then kind of crash completely? Anything you have on that? So
yeah, the jobs report in particular is prone to very big beats and misses, especially for the initial report and sometimes for revised numbers too. And these can have really drastic impacts on the market. I'll never forget 2013 when we had a couple months of very low inflation data just before the Fed's big taper tantrum pivot. Not inflation data, low jobs data. And it was the report that came out on May 3rd, 2013 that really changed the narrative for that. It revised the past 2 months significantly. And now all of a sudden the market was skyrocketing toward higher rates just due to these revisions. And it begs the question, why can't they get it right up front? So one thing to understand about the jobs report specifically is that it's a Herculean data collection effort by the US government. It represents 650,000 institutions, I believe. Two parts to the survey. There's an establishment survey, which just means they're surveying businesses. And then there's the household survey, which they're actually calling people. And so the establishment survey is generating non-farm payrolls, the jobs count, and the household survey is generating the unemployment rate details. And investors can glean different things from those. They can give different messages on any given month. But one thing that's important to understand about the revisions, well, two things. First off, they publish all of their revisions for all of time, going, all the way back at least to the 70s on the current link. And you can see that on years where there has been volatile movement in the economy, that those revisions have been big. And when the labor market is generally expanding, those revisions tend to be higher. When the labor market is contracting or cooling, those revisions tend to take the number lower. So that data series has gotten a lot of flack recently for being a fake government numbers, trying to pump up things before, people making it political. And it's just par for the course. When the economy is cooling, we're going to see the average revision come in lower. They do not have complete data the first month. And there are maybe even some owners of businesses in this audience that are part of that establishment survey that get the emails and reply to that with how many people they have on payroll and all the other questions. And I've had people in MBS Live say the same thing where, yeah, I get that. And I wasn't able to respond before the first one came out. So now I'm responding for the second month, and that's going to show up in the revision. So the more that happens, the bigger the revisions can be. But nonetheless, it's the market's favorite way to get the big official update on what's going on with the jobs market. And so the market's going to continue to trade it.
Yeah, I think just to add on to that is that when the data comes out, I think in this day and age, there's just a lot more of volatility around it with algos kicking in and people trend lining news headlines and and trades hitting in. So you see these momentum trades, and the knee jerk reactions are like ankle jerk reactions. Like they're just bigger now, and they're like moving all the way down. And you're seeing these trends hit, and then immediately you see these huge moves. And it's hard to manage. Like it is a nightmare. It's never the move. Like if we had an orderly move down or up, like all of us would be like very happy. It's easy to coordinate, easy to manage. It's the velocity of the moves that make it a little bit scary on the mortgage side. So when you see these misses and see these huge moves, it's very hard to hedge, get your stuff in order. Like you just have loss. You just have losses occur regardless of going up or down as these speeds happen. And when the things move fast, it's very hard to manage from a hedge perspective. It's hard to get your trades out. It's hard to, the bid-ask spreads widen. It's very, very difficult to manage. So while we always applaud, and it stinks in the mortgage side, we have like some, have some negative news. Sometimes it's positive. You have people like wars are positive for rates sometimes. And there's other things that happen. Obviously 2020 happened and it was positive for rates. So like, there's a lot of things that occur that we kind of have to root for, not really rooting for the things that cause rates to go down. So it's difficult, but those moves and the velocity of the moves are where there's a lot of problems when it comes to the mortgage side and hedging and trading, because it becomes very difficult to manage.
And there's also knock-on effects too. And this most recent jobs report was a classic example, maybe not classic, but a really huge example of a sort of an esoteric thing where it wasn't just about the jobs report, but it was also about what the jobs report meant for potential Fed policy going forward and what that Fed policy meant for the strength of the dollar versus foreign currencies. And in particular, the yen carry trade. You might have read something about this recently. That was something that was fueling excess risk taking in the stock market. And when the jobs report came out weaker, it made the market think that the Fed was more likely to cut rates. When the Fed's more likely to cut, it damages the strength of the dollar relative to foreign currencies. That made yen stronger. And that yen carry trade was really facilitated by the yen being weaker versus the dollar and other currencies. So as soon as that started to reverse, and it was even a little bit before the jobs report, then that yen carry trade caused a massive panic and a liquidation of all of the securities that were bought with that trade. And I'm not going to get into the details of how it works, but it's a Googleable thing, and it's actually somewhat easy to understand. So it had a counterintuitive impact. The fact that the jobs report was weaker than expected, you think, okay, that just means rates are going to go lower. But in this case, it also meant that a lot of trading positions had to be liquidated. And then that helped fuel a further frenzy in the bond market and more volatility.
Yeah. Awesome. Great. And I see a question here, Matt. What do you think is gonna happen tomorrow? What do you think? So that's the key thing. Let's just say what happens to rates if things stay, if we get the number projected, or if it's a little bit worse from an inflation standpoint.
Oh, that's too much specificity. I was going to say CPI is going to come out tomorrow and rates are going to go higher or lower. Then that is, I guarantee you that will happen.
Love it.
Yeah. So one thing to understand, and I have a slide about this if we end up getting around to my slides, is that you're not smarter than the market. Neither am I, neither is anybody. And anything that we can reasonably foresee about the data has already been predicted and forecast by economists and priced in by financial markets. So to whatever extent we know that CPI is going to come in at 0.2, maybe an unrounded 0.167, I don't know. The bond market has already priced that in. So everything happens with respect to how the data comes in versus those expectations. And there are also internal components that different traders might assign different weights to. So I know some traders are very, very keyed in to what's happening with shelter inflation, which dropped in a major way last month for the first time in a long time. And if that continues to be the case, it's going to fuel a lot of belief about the longer term prospects for core inflation staying near the target, maybe even moving below target. So you could just phrase it in terms of headline core CPI, but you could also say, yeah, core CPI could honestly be 0.3. But if the shelter component is 0.2 and other sticky components, things that have really been causing us trouble in the past 2 years, if those are also lower and that 0.3 headline is driven by stuff that's seen as temporary, you could still have the bond market rally despite a higher than expected CPI reading. Now, just to clarify, when it first hits the tape, rates are going to spike really high, really quick at first, but then the market might rethink that over the course of the next hour and sort of recover.
Yeah. So one point to make here from a mortgage perspective and originator perspective, high volatile events are marked on our calendars when we price and trade and when we create rate sheets. So like we know tomorrow's CPI, like the day of the news event is generally going to be, I don't want to call it padded, but there's got to be some kind of additional margin put in to protect these volatile moves. So we know it's going to be a pretty hectic day tomorrow. So we may start out the day with a little bit more margin just to protect ourselves, because that's really the best hedge in environments that are going to be really volatile. And then as the day progresses, decide if we can release margin back or get more aggressive if things have calmed down. What we don't want to do is go out with a price and then all of a sudden things are all over the place and I could be upside down on a lot of trades that are coming in, or we can get picked off for loans that maybe aren't meeting our margin requirements as we go in. So generally speaking, a lot of people that are creating these rate sheets do know there's a volatile day ahead. We're going to pad a little bit. So if you are thinking like on the fence, do I lock or not? You are kind of getting a little bit of step the day before. You're getting probably a little bit more closer to true rates than you would the day of a huge volatile event, a volatility event. So that way that you're not dealing with that padded margin potentially. It might be 5, might be 10 basis points, might not be a lot, but it is a little bit of a head start of knowing that that's what pricing is going to be like tomorrow.
Yeah, it's fantastic to hear lenders talk like that.
So from a system perspective, we call them repricing, like Rob mentioned, on these huge days, you'll see many reprice happening. So just watch out for that. As prices change, the lenders will say there's a new rate sheet available. There's a new rate sheet available. This may happen like 3-4 times a day, specifically on these big days like tomorrow. So for loan officers on this call, just watch out for that. So
yeah, we've actually started an enhancement, Harish, for AFR, and we know how crazy it is. We give the heads up. Like we say it, hey, like we're like teetering on the line. And we sent out an email last week. We were like, hey, we're going to hold steady here we're going to give you guys 30 more minutes to get your locks in, even though I should be repricing, but get them in now before I reprice for the worst, because we understand that you may have sold a rate or sold the program, and then you don't want to turn around and have to change that to your customer. So we'll wear it a little bit on margin to make sure you can get in and get your lock the way you want it. So we've been sending those little updates out as a heads up instead of getting surprised. There's nothing worse when you go in and do your registration and you hit the button and it says, whoa, pricing's not available. And you're like, no, I missed it. And so we get
there's nothing worse than feeling like you're in opposition to your lender partners. So what you just said exemplifies a partnership mentality, which is what the best secondary people I've known throughout the years have always approached it as, which is, hey, if you're not doing loans, I'm not in business either. So we're all on the same team. And the more transparent we can be with each other, the better we're going to do together. So, cheers to you on that.
Awesome. Thank you.
So
Great.
one of the audience, Kelly, is giving a shout out to AFR that your process has completely changed and you guys are really amazing right now. So kudos for that. So Amy,
Yeah,
any other questions you think is tied to this? So one
I
question
mean-
is, what does AFR stand for? Rob, is there a full form for that?
AFR?
Yes.
Yeah, AFR stands for American Financial Resources. So that, but we would just go by this. That's not like really a catchy brandable name. So we've kind of stuck with AFR and AFR Wholesale, and we have our mascot, Howie Lend is the name of the robot house that you see that we just revamped. So that's AFR is American Financial Resources.
Yep. And AFR is in ARIVE. There's a question on that for a long time. They've been the earliest
One of the
partner
first
ARIVE.
ones.
Yeah, one of the first ones, even before it was acquired. And then we do support broker-specific pricing. That's a new enhancement which we just did working with Rob and his team. So if you're not seeing the correct pricing, please contact ARIVE support and we'll help you get you properly set up. So
yeah. And Adam, thank you. Yes, it's we are cleaning up the processes and certainly appreciate it. And we know, from the comments in here that we've attacked all the feedback head on. It's been an interesting ride. But transparency is key, in this, and both with pricing, our processes, everything, we've been as transparent as possible and, are looking for partners to help us. And if there's other enhancements or things that you think that other lenders aren't doing right, let us know and we'll make those changes.
one enhancement I thought about that you were speaking about, if you have a heads up concept where you are telling the loan officer there's a heads up, because loan officers are in ARIVE pricing scenarios, we can figure out how to tell them here is a price and it expires soon. So maybe we can try to see how we can make that work. 30 minutes heads up
Messaging for sure.
Yeah, messaging. So that would be an interesting kind of concept. But I know, Matt, you have some slides. I want to ask one question, which is more general. Like I don't originate and all that, but as a loan officer, this question comes up. What are the main factors I should look at when I'm thinking of pricing? How mortgages are priced today, tomorrow, Fannie Mae has 30-year fixed. Why are they priced so differently across different lenders? So any pointers you can tell our users, like, how are mortgages priced? What are the key factors loan officers should look for when they're trying to figure out what does pricing mean?
Right. So I got a couple different analogies that I've used for this over the years, and none of them are perfect, but it should sort of convey the general sentiment. So you just want to view mortgage pricing as a particular cuisine that you might like out in the world. Let's call it pizza. I know some people are gluten-free, but we're going to use pizza anyway, so I apologize. And that has base ingredients that any pizza company, any pizza shop is going to use to make its pizza. And the number one ingredient across all those pizza places is going to be flour. The flour in this case would be like mortgage-backed securities pricing. That's the raw ingredient that lenders are going to use to determine the foundation of their pricing, because that's the price they're going to get when they sell a bundle of loans or an individual loan to an investor or to multiple investors. And that is the starting point. From there, everybody is using a slightly different sauce, slightly different toppings. They might have overhead in a really swanky part of town in a really swanky building, or they might have a food cart, on the corner of a bad neighborhood. There are a lot of different things that impact the rest of the margin, but a substantial majority of it's going to come from mortgage-backed securities pricing, and then the rest of the operational costs, loan officer compensation. So whatever you set your comp as many people are aware, especially post Dodd-Frank, if you have very low comp, then you can offer more competitive rates. And there's also considerations surrounding how your secondary partners are hedging the loans, what delivery months they're going into, although that's not as big of a consideration right now because all the delivery months are pretty close together. And then just, how they are managing their general flow in terms of, who they're selling loans to, how they're selling loans. Lo and behold, there are even differences in the G fee between lenders. They're not huge, but it's a consideration that can have an impact as well. But if there's only one answer, it's that it's MBS pricing, and that's going to account for the majority of the movement in mortgage rates. Between lenders, it's margins, operational costs, business strategy, compensation decisions, things like that.
Yeah, perfect. And do you want to explain a little bit how rate movements, like, you hear, oh, Fed is cutting rates. So that's not really mortgage rates. So anything about different types of rates, overnight rates and 10-year treasuries and anything
Oh,
else
for
you
sure.
can. So
Yeah, in fact, we have a cool little primer on MBS Live. You guys all get a free 2 months just for being here. So when you check that out, you can go into the marketing section, and our marketing section is probably something, if it was a standalone product, it would be $150 a month, especially in this market, because it's pretty valuable. But you can go in there, and there's a library. It's called the library section, where you can send stuff out to clients to keep them educated on rates. And one of the pieces in the library is, why doesn't a Fed rate cut equate to lower mortgage rates necessarily? And so I know many of you know this, but for those of you that don't, by the time the Fed cuts rates, the bond market has long since reacted to all of the forces that are leading the Fed to cut rates. So the bond market can trade hundreds of times every millisecond, depending on what part of the bond market you're talking about with high frequency trading. And as soon as any piece of economic data comes out, it's having an immediate impact. And you can see that in real time, when you're watching the data and watching on MBS Live, you see the econ calendar flash, and then you'd see pricing go crazy. So it's instantaneous. The Fed only meets 8 times a year. So if they can only cut on their schedule, apart from emergency cuts, which are very rare, then the Fed is really catching up to where the bond market already is. And there are even contracts called Fed funds futures where the market can bet and hedge its expectations for what the Fed is going to do at the next several meetings into, almost 2 years in the future. So by the time the Fed gets around to actually making the decision, the markets have really already figured it out.
So one of the questions even I get asked, our brokers ask, is, should I float or should I lock? Any words of advice?
Yes.
Exactly. I saw a question pop in just real quick. So we mentioned G fee a couple times here today, and just G fee is a guarantee fee. And that's what I put in my slide earlier, was just, it's a fee on conventional loans that comes off the top. That's how we describe it. There's a coupon, then you have your G fee that goes on top. It's upwards of 50 to 55 basis points. Could be more. There's some now more parity. It used to be much more opaque on how that was charged, but that's an adjustment to rate that the GSEs charge every lender that are delivering, and it's in all of your pricing. This is before LLPAs. LLPAs are to price. G fees are to rate. So that's there. So it's a significant price adjustment for the G fees that are there. And it's just an insurance policy. It helps subsidize some of the programs that they're doing, like waiving LLPAs and doing the other LLPA changes that they've done, affordable housing initiatives. It helps cover all of it, since every loan gets hit with a G fee. So I just wanted to add that. And then there's one that maybe Matt can help with here, is a question about conventional 15 years have not moved at all compared to 30-year. We see that a lot. And that's, probably appetite for kind of the backing and kind of what's happening in this inverted kind of, in yield curve market. Can you just go over why 15 years not pricing quite aggressively like 30 years?
Yeah. And I would say, it's maybe not as aggressive, but 15s are still a little bit lower last I checked, and they have been responding to market movements, but yes, not as much as you would historically expect. And Rob's exactly right. It has to do with the shape of the yield curve. 15-year MBS are typically shorter duration, and most of the time that doesn't matter, because the yield curve, and that refers to the distribution of yields ranging from super short-term debt to super long-term, which makes a curve, has been a relatively stable shape. During times where it's in a state of flux, that can cause problems, especially right now where the yield curve has actually been inverted, where short-term rates have been higher than long-term rates. And yes, we did technically uninvert for a moment last Monday morning, but the fact that we're even that flat is bad news for short-term rates. And it means that something like a 15-year isn't going to be as advantageously priced versus a 30-year as it historically would be.
Awesome.
So one more question, Matt, unless there are other questions. So as our users, like loan officers, look at markets in the future, this year has been pretty brutal. A lot of originators have left the industry. And I know nobody has a crystal ball, but with whatever indicators you are seeing, we're in an election year, all this data coming in, any words of wisdom you can provide, like what's going to happen in next 6, 9, 12 months? Anything you want to at least foresee, rather than just wait and watch, if you will? So
yeah, first thing is, like, I don't put a lot of stock in election years, other than there can be market volatility, but there's no ironclad guarantee of rates moving one direction or another on an election year, regardless of which party ends up in control. I will say, anytime with respect to politics, and we really try to stay away from that on MBS Live because I really hate politics and I really think it's overplayed as far as its relevance for the bond market. But the time that it is relevant is when one political party has full control of the government, because that makes it easier for that party to spend money. And when it's easier for either party to spend money, and they both do it in different ways, you have more net treasury issuance, and that increases the supply side of the bond market equation. And higher supply means lower prices, and lower prices mean higher yields, and higher yields mean higher rates when it comes to bonds. But looking forward, next 6 months, this is addressed significantly in my slides if we get to that. And I don't know, Harish, if you're going to let me,
Yeah, no, I think I was coming to come to that. Maybe you can quickly skim through the slides. We have about 10 minutes left. So, since you have them, and maybe.
Well, you got to tell me, if you want to end your part and let me have more than 10 minutes, I'll take it. I guarantee you there's 7 people here that are going to be really excited. Maybe 70, I don't know. But I can definitely take more than 10 if you give it to me. If you want me to take 10, I can.
Go for it. We'll see how it goes. We have time till 11. So why don't you share your slides, maybe kind of give some overview to our audience about all these interests. You're a professor here for all of us. So let's go for it.
All right. Can everyone see my screen?
Yes.
Yes.
All right. We're going to have a little bit of fun. I'm going to move a little bit quickly. If I lose you, please understand you have this 2-month trial to MBS Live. Jump into MBS Live, say, hey, Matt, I was on your thing with ARIVE and you lost me. Let's talk. I'll talk. We could even do a live session some afternoon and go over these in greater detail. But anyway, I'm here to prove to you that everybody's too excited about rates going lower, and that rates are actually going to go higher, and everybody just needs to watch it. So first off, we've seen these false starts several times on the way up. Here's a chart of 10-year treasury yields. Those aren't the same as mortgage rates, but they're a benchmark that sort of mirrors and matches the way mortgage rates move. So these false starts happen when rates make a new long-term high and appear to bounce only to move back toward higher highs. So first in mid-2022, rates had spiked brutally, and then we had this nice little recovery, and we thought, oh, that's awesome. It's finally over. But then when 10-year yields got down into the lower 2% range, they bounced brutally and set another new high. Then in response, we had another recovery, and then another brutal acceleration into the end of 2023, another recovery. And now we're sort of in this, sideways unknown time, but we importantly still have not broken below this technical level that was set when we made this big low in early 2024. So unless we're breaking through that in a compelling way, we still have a trend that is pointed toward higher rates. This is what technicians would call a trend channel. Rates may have rallied recently, but they're still in a broad uptrend, and the trend is your friend until it's not anymore. How about fundamentals? Fundamentals refer to the economic data and the other components that inform how traders should be trading. So this is a chart of inflation back in the day, the last time that we had anything remotely similar to the inflation environment we're seeing right now. We have periods of ebbing inflation shown in green, followed by resurgences in red. So false starts happen here as well. And there was nearly a decade of drama the last time inflation was as high as it is now. And interestingly enough, the initial spike in the 60s, late 60s, looks exactly the same as the initial spike now. And look at what happened back in the 70s after that initial spike in the 60s. A lot of people would say this has to do with government debt issuance and other things that people aren't really respecting. People are just looking at economic data, expecting that weak data is going to save the bond market, but they're not really respecting the issuance. Some people are saying, yeah, but the labor market's softening. Is it? I mean, yeah, non-farm payrolls have come in lower than expected, and that should be good for rates, and it was. But we're just back into the pre-pandemic range, and we're not moving meaningfully below it. So there's going to be a little bit of a bumpy landing, connecting back with this historically normal trend. And if we were moving down below this lower white line, that might mean something. But if we're in this range, it's not really proof positive that the labor market is soft enough to guarantee lower rates. And by the way, this is non-farm payrolls, the headline component of the big jobs report. How about something more timely? This is weekly jobless claims. And weekly jobless claims have been a little bit problematic in terms of seasonal adjustments because this spike that we tend to see in the summertime has bled through to the seasonally adjusted numbers. So this chart actually looks at non-adjusted numbers, and some people are surprised to see, you always see a big spike in claims around the changeover in the year. That is definitely well filtered out by seasonals. So this won't look like, you're not seeing 400,000 jobless claims a month. This is all seasonally adjusted down into the low 200 range. But here's the
I
important
remember
thing.
when nobody cared about this, Matt.
Totally.
This
And
used to be like
nobody
a
tells-
non-point, but then all of a sudden it became like a huge market mover,
People never care about jobless claims until they're looking for that earliest possible evidence that things are shifting in the labor market, which we are right now. And so Ernie Tedeschi, a former White House economist who has a great Twitter feed that I recommend, I learned this little trick from him, we got to throw out 2021 and 2020 because those would be completely off the chart on this chart. But we go all the way back to 2017 to get a solid baseline, and we can see every year, other than those two crazy years, looks about the same. And while a couple weeks ago, this red line, which is 2024, a couple weeks ago looked like it might be taking off and moving higher than the trend, but since then it snapped back in line with the trend, and here we are again thinking, okay, maybe the last jobs report was a little bit too weak, and maybe the labor market is not really in trouble yet. And then how about that treasury supply? Right, this is a big topic of conversation. There's always more and more. It really only moves in one direction for the most part. And yeah, you had some of the balanced budget years down here where things leveled off. That was nice, but maybe there was some unforeseen income from the internet. I don't know. All I know is that supply has exploded. The more supply we have, the tougher it is to deal with, the more upward pressure it implies on rates. And this is an experiment. Like, we are still in the infancy stages of experimenting with being the world's reserve currency as the US dollar and being able to issue as much debt as we are. And we've never issued this much debt at this high of a rate. And then in terms of debt to GDP, people say, yeah, sure, but if you look at debt to GDP, we're really not doing that bad, except we are. It's a lot. Just because we're not the highest country in the world doesn't mean that we're not at the highest levels we've been at, apart from the very early days of the pandemic. So we really don't know what the end game is here, and it's a very big risk to the rate outlook. Combine that with the fact that the Fed is not buying treasuries or MBS anymore. So our biggest buyer is gone, and they are actually letting their holdings roll off the balance sheet, especially in MBS. What that means is they're not reinvesting the proceeds from the bonds they had bought in the past. Bottom line, when this blue line is moving lower, it just implies less and less demand for the bonds that would help rates move lower. So my recap on all the preceding slides: you're pretty scared, you're feeling pretty down, you're like, what the hell is this guy trying to do? Is he trying to ruin my day? The nice thing about all that is that the recap of all these slides is as such. They're horseshit. Let me now tell you, I was trying to convince you of something because I was the guy with the microphone, I was the expert, and I could go through those slides and make a case for something, and it's believable. And all of the charts that I presented offer an actual foundation to believe the things I told you. But ultimately, it's horseshit. I mean, it might not be, but it is. There are far better reasons to expect rates will go lower. Now we're going to get into some kind of in the weeds technicals. I'm going to move through them quickly. You don't have to understand them. MBS Live is not all about these technicals I'm about to show you, and technicals just refer to technical analysis, which is sort of a mathematical way of looking at the market. Regardless of what the fundamental data is telling us, we can just look at how the market's actually been moving for clues as to how it might move in the future. So you may have heard the term stochastics on some advertisement on CNBC at some point, and it's just some math that's applied to various closing levels in any security, but in this case, in 10-year treasury yields. And it creates these two funky lines that you see at the bottom of the chart. And then traders can look at how those lines move to sort of glean cues about how the future might unfold. And the long story short is, when these blue lines are crossing below these orange lines, it is a positive indication for bond yields. It means rates are going to move lower. And most recently, we have a nice cross in effect. And that means our next move is going to be lower rates, at least for a few weeks, if not a few months, based on the duration of this chart. So from a stochastic standpoint, if you're only going to follow one chart, this one guarantees you rates are going lower. It even works longer term. If we bump this out to a month by month chart and change it to a these parameters, the 44, 22, 22, you can set those in a number of different charting packages on various websites. And what I'm saying is you can feel free to check my math. I'm actually not trying to fool you here. Is the same thing happening in this bigger picture standpoint. And note, if you're sitting there thinking, hey, we were in a secular bull market since the 1980s and rates only ever went down through the time frame of this chart, you are onto something, but don't ruin my joke at the end. Okay, but
I think we should make this a TikTok challenge of providing this chart and going into the numbers. And every LO out there has to post it to a realtor and see the reaction of what that is. And like that would be a good TikTok challenge, I think.
You got to be careful. Realtors are going to start telling their clients they're going to be 47 rate cuts by the end of the month, and then they're going to call you and say, "My realtor told me rates are going to negative 17%."
Exactly.
Other technicals. So this Bollinger Band business, you might have heard that. That's a pretty common one. It creates two bands based on standard deviations from a chosen mean. In this case, it's a 21-day exponential moving average, which is the standard for Bollinger Band study. That's this blue line that is smoother, not the blue line that's bumpy, that's actual yields itself. And then the green line is the lower envelope, and the red line is the upper band or upper end of the envelope. And there's a pattern called the M top and a W bottom. And you can go to stockcharts.com. He does a good job of explaining what these mean. But we've had a classic M top, and then you can combine that with a moving average convergence divergence model, which shows a divergence in momentum that is not matched by the divergence in yields. This is really best seen when yields actually bump the same ceiling twice in a row, but then you have a momentum technical like a MACD that's moving lower. That's called a bullish divergence in the case of bonds. And it just means, okay, the yields are bumping up against roughly the same ceiling, but the momentum is actually showing the underlying sentiment is driving toward lower yields. It's just another feather in the cap of a potential bond rally. And yes, I think, you guys will have this PDF, a PDF of all these slides will be available, and a recording of the webinar. So I know I'm moving really fast, but I just wanted to reassure you, A, you don't need to understand it, but B, it's available if you do. Then if you want to get really in the weeds, there's a piece of technical analysis called Ichimoku Kinko Hyo.
That's what I came here for, was the Ichimoku cloud.
Yeah, most people did.
About it. That's why I'm here. Yeah. Nothing about pricing. I want to know this.
And I have, I've read other analysts that are smarter than me that actually put this out in their daily chart package and never really gotten into following. I mean, it's not something I look at every day, but it exists and is really popular among the people who use it. I can't give you too many details on it other than what's notated on the chart, which is to say there are various equations applied to actual bond yields, and then they create these 4 lines. And the 4 lines are pretty much summarized by the bullet points on the chart, which is you have the red and the green line forming the cloud, and then you have the blue and the orange line forming the indicators. And the general rules are when the green line is above the red line, that's bad for the trend. It means that rates are going higher. And so right here, you can see the green line just crossed below the red line for the first effing time since rates began to spike. Yeah. How amazing is that? And then you have when the blue and the orange line are above the cloud, it's bad. And when they are entering the cloud, it's a sign the trend may be shifting. So they entered this cloud last week. And when they move below the cloud, it's a confirmation of a trend reversal. So this Ichimoku is telling you, however you would say it in Japanese, that things are about to get better.
How do you say float boat in Japanese? I think that's what it's saying. It's saying.
I wish I knew. I know how to say like my name is Matt, but that's about it. And then if that all is too technical, how about fundamentals? Inflation. We know that's a big driver. We talked about this a little bit at the beginning of the webinar here, but core inflation, I mean, look at the chart. This is core inflation. Yeah, we're not at target, but where are we heading? It seems pretty clear the momentum is intact back toward there. And if that's not enough for you to feel good about inflation, let's talk about month over month core CPI. Oh my gosh, the green line, 0.17. That's the thing that annualizes out to a 2% inflation target. We've now been at or under that for 2 straight months, and we have a chance to be at or under that again tomorrow. If we're at or under that again tomorrow, things are freaking phenomenal and rates are going to move lower. But even now, we are at the lower end of what had been the historically normal range that resulted in 2% core inflation over time. So this is really,
That's a big
even
one.
though I'm going to pull the curtain back and trick you again at the end of this, this is pretty legit. This is pretty exciting if it continues. Here's the other thing that is exciting. This is a little bit complex to understand, but it's actually simple underneath. And it's a good thing to keep in mind. There's a concept called residual seasonality. You can Google it. There's a paper on it. It's a little bit dense, but I'll tell you what it means. It means that as government agencies apply their ongoing seasonal adjustments to various data collection efforts, they change over time and they're imperfect and they're constantly needing to adjust for new realities. And in the constantly descending inflation environment post 1980, it created, it trained these algorithms that decide the seasonality maybe a little bit incorrectly, such that if you take an average of the first 6 months of any given year, they're always higher than the average of the next 6 months. Could some of that have to do with the secular bull market where inflation and rates are always going down? Yes. But at the same time, those are the seasonal adjustment factors that are still driving the current numbers. Some economists have said it's no longer going to be a problem. I don't know. But the point is, this red line, the fact that it is mostly above the dotted line means that the first 6 months of the year, the first half of the year, has been above the second half of the year almost exclusively, with only a few exceptions. So that's another reason to sort of take the Q1 inflation data, which was really high and really troubling for the bond market, with a grain of salt. And then how about rates themselves? We can look at fractals, patterns that repeat themselves in charts. So the current rate environment looks a lot like the mortgage rate spike in 1980, where we had this initial bump, initial recovery, and then a subsequent higher peak before ultimately getting back down to lower rates. If we had to only choose one other moment in history that's like the current moment, it would be that one. And we are just coming down the other side of the mountain according to that example. And then how about economic indicators like the unemployment rate? Doesn't look great. You know, it's lifting up off the bottom. It seems to have encountered technical resistance here, just under 4%. It's a classic pre-recession pattern that looks a lot like other parabolic rounding off, bottoming out patterns that we've seen in the past. So that's exciting stuff. Again, not if you're somebody losing their job, but hey, look, let's face it. If we're loan officers, we've taken our lumps. I mean, you know, what's worse than having a job that you do and not being able to make any money at it? Hey, I'd rather lose a job and have somebody tell me, hey, go find a different line of work. So loan officers, it's okay if you want to feel okay about unemployment rate going up. And this is not something that really goes any other way. When the unemployment rate bottoms out like this, when it rounds off at the bottom and starts moving up, it's never a gentle thing. It means that unemployment is about to move up quickly. We might not see the reason for that yet, but the reason will definitely be understood and proven out in hindsight. And then in the short term, here's what the unemployment rate looks like. So if you were just to look at this chart and say, oh man, labor market's definitely softening, and the Fed has said they're going to pay more attention to a softening labor market when they decide whether or not to cut rates, this is pretty much, it's pretty conclusive. And then people will say, but inflation might be softening in the data, but eggs are $7 and everything's so expensive. And the sandwich I used to pay $11 for is $17. So like, no, man, prices are super high and businesses aren't going to cut prices. So if businesses aren't cutting prices, inflation can't go down. I love that person. Like, give them a hug and pat them on the head and say, just remember, okay, prices are different than inflation. Prices indeed are not coming down. Some prices might, but on average, prices will not come down. Inflation is the measurement of the change in prices. So if that sandwich still just stays at $17, okay, it doesn't need to fall back to $11. If it just stays at $17, inflation for sandwiches would be 0%. And if inflation is 0%,
that'd be
below target. Right. And the capitalist machine will not be functioning if inflation is at 0%. And so then rates are going to be really, really low. There might even be some stimulus for 0% inflation. So it's just important to remember the blue line is prices. This is the actual consumer price index. It doesn't go down. Okay. Look at this. I mean, everybody, seriously, this was the blip in prices for the great financial crisis, the largest recession since the Great Depression. Okay. How does that look in the big picture? Pretty insignificant.
Yep.
If you look at the year over year change, it was a very big dramatic dip, right? But so we're just hoping for this year-over-year change to get back to 2%. Prices themselves not coming down. And this was just another chart that sort of backs up the same thing. It just it examines a couple different components of inflation, showing that, you know, when somebody talks about sandwiches at their sandwich place being $17, you can show them, yeah, that may be, but look at how the price of that sandwich has changed. Look at the actual inflation rate of it. So food away from home, everything, you know, eating out is the green line, food at home is the blue line, right back in line with historical norms as far as food at home. So how would we classify the predictive value of all those upbeat slides, since they're a little bit different than the downbeat slides? And so here again, many of you see this coming, but it's also horseshit. Now, the last time I did this presentation, as I went through those positive slides, I said, you know what, screw the horseshit, because I actually feel like there was more merit to the upbeat slides. And this was June 25th at a presentation I did in Dallas. And since June 25th, rates have done pretty good. So I must be able to predict the future, which is freaking awesome. Great news for you guys. You can just tune in. I'll tell you where rates are going to go in the future, except predictions are for suckers. So, you know, pardon my French, but this is really important to understand. We touched on it earlier in the presentation. There are no gurus. There are people that might say something based on a piece of technical analysis, and it might pan out. And then you might say, oh man, that person totally called it. Look at all of their calls and see what else they predicted and maybe how that didn't play out. But no matter what, if you're making calls, if you're making predictions, or you're following somebody who is, make sure you understand them in concrete terms and they're written down and they're quantifiable. And it's not just something that you can go back with a revisionist history and say, yeah, well, I did say this, and so that technically means I was right. No, you have to mathematically be able, somebody else has to be able to make a trade based on the prediction that somebody else made in order for that to be an actionable prediction. Otherwise, it's just whoever has the mic trying to convince you they're awesome. And I am the last person that's going to try to do that. I would rather convince you that I'm just going to give you the straight talk and let you know what's going on.
I think it's important to kind of correlate what you're talking about, Matt, and then the lender's reaction to these things. So that's something we can predict and say like, hey, this is something that you can attribute to a certain basis point in price, and kind of be in a position where you know pricing is going to widen a little bit, or you're going to see pricing in certain areas get worse. There's some discussions about the government bonds and Ginnie Mae bonds and like pricing when it comes to that. There's some discussions on the street about FHA versus VA going into Ginnie Mae and pooling concentration. These are things that are outside of market conditions, but they're outside of the overall kind of macro look. And these are things that are happening now that originators can act on. But getting the data and getting the information and knowing when the trade is happening or when reprices are likely, it is important. It is important for an eighth or a quarter or a half potentially an interest rate. It does matter to the originator. And we all know originators love, like, just what's a better feeling than saying, hey, you remember I quoted you 7, but today it's going to be 6, 8, 7, 5. That call is the best call you can ever make, as an originator. And here you have the opportunity with the data and the tools here, and you see, oh, wow, 3 reprices happen. I want to send it to this lender. They haven't repriced yet. I'm going to hold off a little bit and let me see. Yeah. And I'm like, I hate to say calling it playing with house money, but when you see moves and you're on a platform, it doesn't have to be your full-time job, but being aware of it and know how this stuff works goes a long way. Just look how many people, 200 plus people, are staying long to listen to you talk about this, because there is a desire to learn this information, because in this point and click origination world we're in, it's been lost. There's a lot of this stuff has been lost in the originator world. So this is great to gain this knowledge, get this in, and the better you can be at it and the better versed you are at this, the better originator you can be, the better partner you can be for your referral partners and for your borrowers. So I definitely want to thank you for all of this. I know, is there anything, Harish, I know you're squirming over there. Actually, you're like, we're way over.
You're okay. I think this was
so valuable.
No, absolutely. Thank you for giving us a crash course on mortgage 101 pricing. I promise to be a straight A student. I hope our loan officers also do their best.
Thank you, Harish. Thank you, Matt. Thank you, Amy. You guys rock. This was awesome. Incredible. I learned a lot today. I want to say thank you to the team here. Really appreciate you guys having us on.
But yeah, thank you so much. Thank you for your time. Thank you.
Bye, guys.